If accounting is the language of business, then journal entries are the sentences, and debits and credits are the words. So let's do a little bit of practice to review chapters 1 through 5 with some journal entry practice. Remember our rules? Debit means left, credit means right. One isn't good, one isn't bad. Please don't think about the use of debits and credits in other aspects of your life. Just remember, debit means left, credit means right. Our journal entries are always balanced. We always have the same dollar amount of debits as we do credits. Assets increase with debits. That's easy to remember because they're on the left-hand side of the balance sheet, and debit means left. Liabilities and owner's equity accounts increase with credits. That's easy to remember because they're on the right-hand side of the balance sheet, and credit means right. Expense to debits, expense to debits, expense to debits. That's easy to remember because I said it a billion times already. Revenue, which is the opposite of expenses, that must increase with credits. And drawings starts with D. That reminds us we record drawings. Owner's drawings are recorded with debits. Maybe it's easier for you to think of the books analysis, which is the same thing. Assets increase with debits, liabilities and owner's equity accounts increase with credits, and expenses increase with debits, and revenues increase with credits. Or maybe it helps you to think of our chart. Assets increase with debits, liabilities and owner's equity accounts increase with credits. Expenses or debits, expenses or debits, expenses or debits. Revenue accounts increase with credits, and owner's drawings start with D, so that reminds us to record those with debits. I put the expense and revenue accounts in red font because those are income statement accounts. Everything else is a balance sheet account. Okie dokie, let's do 8 quick journal entries. On January 1st, 2017, the owner invests $300,000 into the new company. What's happening to cash? A lot of the times when we're learning accounting, a great question to ask yourself is what's happening to cash? If cash is going up, cash is an asset, assets increase with debits. In this case, cash is going up. What's happening to the owner's equity of the business? It's increasing. He's investing another $300,000 into the new company. So we put the date out here. We debit cash for $300,000. We credit owner's capital for $300,000. And we make a little memo to tell the next person who's using the books exactly what just happened. Okay, let's look at the next transaction. The company borrows $500,000 from an insurance company with an interest rate of 12%. Don't be fooled by this insurance company language. We can borrow money from the local bank, from an insurance company, from rich relatives. It doesn't really matter from whom we borrow the money. Let's ask ourselves what's happening to cash. Well, if we're borrowing money, our cash is increasing. Cash is an asset. Assets increase with debits, so we're going to be debiting cash. We signed a note when we borrowed the money, so when we sign a piece of paper, that's a note payable. Note payable is a liability account, and it increases with credits. So we put the date out here, we debit cash for $500,000, and we credit notes payable for $500,000. We make a little note to ourselves to remind us that this is the prudential 12% note. All right, this the next transaction on January 6th. Company buys $100,000 of office equipment on account. What's happening to cash? Nothing. But office equipment is an asset. Assets increase with debits, so we're going to be debiting office equipment. When we see the word on account and we're buying something, that means account payable. The difference between a note payable and an account payable is we sign a note when it's a note payable. An account payable is just a verbal agreement with our supplier. So again, we put the date out here, we debit the asset office equipment for $100,000, and we credit accounts payable for $100,000. Accounts payable is a liability account, and hence it increases with credits. And then we put a little memo down there to tell the next person exactly what just happened. Okie dokie, let's look at the next one. January 7th, company buys inventory for $100,000. The terms are 210 net 30. In other words, if we pay within 10 days, we get to take a 2% discount. If we don't pay within 10 days, we still owe the full amount before 30 days expires. We use the perpetual inventory system. Well, if we're using the perpetual inventory system, that means we debit inventory. In the periodic inventory system, we would debit purchases. But we're in the perpetual, so we're going to debit inventory. And since we're going to pay later, we know we're paying later because it gives us the terms, we know we're going to credit accounts payable. Again, note payable is when we sign a note. Accounts payable is just a relationship we have with our supplier. It's a verbal agreement. So we put the date out here. We debit inventory. Inventory is an asset. Assets increase with debits. And we credit accounts payable. Accounts payable is a liability account, so it makes sense that it would increase with credits. Then 3 days later, we pay for that purchase. So since we paid within 10 days, from January 7th to January 10th is only 3 days, we get to take a 2% discount. So instead of paying $100,000, we pay that bill off with a check for $98,000. $98,000 is 98% of $100,000. So we'll reduce the cost of our inventory because we only paid $98,000 for that. So that accounts payable was on our books with a credit of $100,000. So to get rid of it, we'll debit accounts payable for $100,000. We only write a check for $98,000. Cash is an asset. Assets increase with debits, they decrease with credits. And inventory decreases with the credits. Since we're in the perpetual inventory system, we're perpetually updating our inventory account. And we'll add a little memo down here. So when we pay early enough to take advantage of a discount in the perpetual inventory system, we reduce the cost of inventory on our books because the perpetual inventory system is about perpetually updating our account called inventory. The next transaction tells us that we sell some goods for $50,000. They were in our inventory for $30,000. So we did the right thing. We bought something for 30, we sold it for 50. That's the whole point of selling things. Buy them for something, sell them for more than that. Since it tells us the terms, 210 net 30, if our customer pays us within 10 days, they can take a 2% discount. We know that it's not a cash sale. So that means they're going to pay us in the future. That's an account receivable. Account receivable is an asset. Assets increase with debits. We book the sale. Sale is a revenue account, so we're going to credit revenue. And since we're in the perpetual inventory system, we're also going to update our inventory. We're going to take $30,000 and move them out of inventory into cost of goods sold. Cost of goods sold is an expense, so we're going to be debiting cost of goods sold for $30,000 and reducing inventory with a credit of $30,000. So when we sell something in the perpetual inventory system, there are two journal entries. One records a sale. This is a credit sale, so we didn't debit cash. We debited accounts receivable. This is the sales. This is our revenue account. It increases with credits. Expenses are debits, expenses are debits, expenses are debits. Cost of goods sold is our most important expense. It's the one with us first. So we record that cost, and then we also reduce our inventory by $30,000. So in the perpetual inventory system, we book the sale, and we update our inventory account. Okay, the terms of the sale were 210 net 30. If they paid us within 10 days, they get to take a 2% discount. Well, now it's 6 days later, and they pay us. So that means they get to take a 2% discount. They owed us $50,000, so they're going to only pay us 98% of that. 98% of $50,000 is $49,000. And sales discounts are when customers pay us early. Accounting students, when they can't get journal entries to balance, they are all the time doing various things with sales discounts. Sales discounts are when customers pay us early. In this case, the customer paid us early, so this is an appropriate use of the sales discount. The customer is paying us cash. Cash is an asset. Assets increase with debits. That account receivable was on our books with a debit of $50,000. Now we zero it out. They don't owe us any money anymore. So we have to zero out their account with a credit of $50,000. To make that journal entry balance, we have a $1,000 debit to the contra revenue account called sales discounts. Sales discounts are when customers pay us early. So now it's the end of the month. It's time for an adjusting journal entry. We have to accrue for interest expense on that note. Remember, we borrowed $500,000 on January 1st, so 1 month has gone by. $500,000 times 12% a year is $60,000 interest expense for a year, but we've only had the use of the money for a month, so we owe 1 month's worth of interest. We owe $5,000. Expense or debits, expense or debits, expense or debits, so we debit interest expense for $5,000. We're going to pay it later, so we credit interest payable, and we make a little memo to ourselves. So whether you memorize the 6 rules, or you use the book's graphic representation of the accounting equation, or you use our little chart here, best way to learn journal entries is to just keep practicing, practicing, practicing. Hope that helps.